So where are we today? The standard setters, maybe you have heard of the alphabet soup of acronyms that people think of when they think of the standard setters. You have the GHG protocol, the GRI, the Global Reporting Initiative, the TCFD, which is the Task Force on Climate-Related Disclosures, and the SASB, the Sustainability Accounting Standards Board. All of these standards and frameworks, they have very similar goals, right? They're trying to help companies present ESG material in the most efficient way possible. They're not intending on duplicating their efforts, but they did establish, slightly different rule sets and are meant to be incorporated into a company's decision-making when they're reporting on ESG efforts. Regulators, where I think we kind of need to get to in order to make many companies report and have comparable information. As you may know, the SEC has eagerly been trying to release the SEC proposed rule on climate-related disclosures. I'll get to the timeline of that in just a bit, but broadly speaking, we hope that that is final soon, because I think that will drive a lot of businesses to finally bite the bullet and be on the forefront of actually reporting. Investors, much more often now than ever, investors have been talking about companies and their ESG reporting. So if a company has maybe done very well in one area, but not in another, they've asked companies to reconsider. So I know one example, BlackRock and State Street Capital, they've actually been bold enough to tell people to reconsider their directors. If they're not putting this top of mind, if they're not prioritizing ESG, then maybe they have to reconsider the directors that they have at the company. So some companies are more bold than others, but generally speaking, if you think of making an investment, many of us would like that investment long-term to be profitable. And so in many ways, if companies are not incorporating all of those 5 pillars, then there's a chance that they're not going to be a long-term business plan that will be profitable in the future. And so investors are obviously very akin to that. And corporations, I kind of intertwine that into the other 3, but broadly speaking, corporations are prioritizing this now, one, because they have to with the rule set coming out, but they went from kind of a defensive saying, I'll report this when I have to they're on the offensive. They're looking at their peers who have already reported. They're, setting targets and hoping that they can meet those targets. So that's kind of how you incorporate that into one of our key drivers. I won't bore you with each of these, but this is an example of some of the frameworks I mentioned. They kind of all are falling under the ISSB, so the International Sustainability Standards Board. So maybe you're familiar with the IASB, the International Accounting Standards Board. These run alongside each other, and like I said, they all have some nuances that make them different. Maybe their focus is on a different area, like the GHG protocol is focused on those 3 scopes that I went over. But broadly speaking, their goal is to help companies report and help them have some kind of clarification on what they need to do to report before they actually have the regulation in place from the SEC. But here we have the SEC proposed rule. So back in March of 2021, the rule set came out. There's a 60-day comment period, right? And during that comment period, the SEC solicits feedback from the public, whether it be companies, investors, individuals. They received about 14,000 comments on their proposed rule, which is a decent amount. And the process is that they address those comments, they get back to companies, and then they have to, make some updates. Their timeline was based on that comment period concluding. Originally, they said that the rule set would be final sometime around October. That didn't happen. Then they came back and said it would probably be sometime between the midterm elections and year end. That has now changed. Just in the news last week was that there was some technical glitch that happened while the comment period was open. And so they have to reopen for comments, which they did in the past 2 weeks, re-solicit comments and kind of start that review process over. So they're thinking now of predicting that the rule will be final in the first quarter of next year. So people like us who have been eager for this to be final, that news wasn't great, but the timeline I think might shift just a little bit because of that. So really the biggest start was for large accelerated filers they would be required to have a disclosure for scope 1 and scope 2 metrics in their 2024 financials. So 2023 financials filed in 2024. So, and you'll see as the timeline shifts over time, the rule set asks for reasonable or limited assurance on that information. So while companies have slowly been more proactive in getting the data and measuring the metrics that I've listed, we've been urging, you know, sooner rather than later, because especially when you get to the point of needing assurance over that work, it's more than just calculating a metric. It's understanding the control and environment that you have in place in order to achieve some metrics and some targets that you have. The rule itself is split up into two main buckets. You have the financial statement impact and the impact to your disclosures. So financial statement impact, I mean, thinking mostly climate related events. So I like to think of, you know, if you're a company that relies on clean water in order to operate your business, are you located in a company that's been experiencing droughts? You know, how is that going to impact your financial statements? You know, will your revenue over time be affected? So, you know, companies will have to consider that. And then the biggest one in the disclosure realm is the scope 1, 2, and 3 emissions, which we went over for a bit.